Imagine playing a game without a scoreboard. You know who won each round. You know who lost. But no one can tell you who's ahead overall. That's what early stock markets were like. The stock market didn't always know how it was doing. There was trading and there were prices. There were fortunes made and lost. But there wasn't the market. No single number. No daily verdict. And no sense of collective direction. Then, quietly, the market got a mirror and started watching itself. And once it could see itself, everything changed. Not because people became irrational, but because measurement rewired incentives. In the 1800s, investors didn't say, "The market is nervous." They said, "Railroads are struggling. Shipping looks strong. That bank overextended." Investing was fragmented. Each stock was its own story, and each industry its own world. If a stock fell, it was that company's problem. There was no shared emotional center. If prices fell, they fell locally. No panic spread automatically. Prices existed, but there was no summary. No headline number. No shared mood. As markets grew, they became harder to understand. And this fragmented view stopped working. Too many companies. Too many prices. Too many updates. People felt lost. Not scared, but disoriented. People wanted simplicity, orientation, and context. They wanted a shortcut. Something that answered a simple question. How are things going overall? That question didn't exist before, and answering it changed everything. Early stock averages were modest. A small basket of major companies and a rough average. No theory and nothing fancy. The Dow Jones Industrial Average, created in 1896, wasn't meant to guide behavior. It was meant to describe. Like a thermometer, not a steering wheel. Charles Dow didn't think he was shaping behavior. He thought he was reporting weather. Up, down, cloudy. But once people saw the number, they started feeling it. And once a number exists, people start reacting to it. Here's the subtle shift. A falling stock used to mean, this company has trouble. A falling index meant, something is systematically wrong. The meaning changed. Once the market had a score, losses felt collective and gains felt shared. The market wasn't just a place anymore. The market became a mood. It became a thing, and things can be judged. Daily index numbers did something subtle. Millions of people checking the same number at the same time every day. That never happened before. Indices synchronized attention. And synchronized attention creates synchronized reactions. Optimism spreads faster. Fear spreads faster. Not because people panic, but because they're looking together. The market developed moods, and moods influence decisions. Indices didn't just report prices, they told stories. A rising index said, things are going well. A falling index said, be careful. These messages weren't commands, but humans respond to signals, especially shared ones. At some point, indices stopped being descriptive and became benchmarks. Investors no longer asked, did I make money? They asked, did I beat the market? That's a big change, and this changed incentives. Safety became relative, and risk became relative. Once performance is relative, behavior shifts, risk-taking adjusts, time horizons shrink, and decisions cluster. Standing still felt dangerous if the index moved. As professional money management grew, indices gained power. Fund managers weren't judged on wisdom. They were judged on comparison to the indices. Underperform too long, you lose clients, and you're gone. That creates pressure, and that pressure shapes decisions. There wasn't pressure to be right, but pressure not to fall behind. This encourages herding, short-term thinking, and defensive decisions. Not because managers are foolish, but because incentives demand it. From the outside, herding looks irrational. From inside the system, it's survival. Being wrong alone is fatal, but being wrong together is forgivable. Indices reward alignment. Here's the turning point. The index measures the market, but once behavior responds to the index starts influencing what it measures. Good performance attracts inflows. Inflows push prices higher, and higher prices improve the index. The loop closes. The market begins watching itself and responding to what it sees. No one designed this. No conspiracy, no switch flipped. It just emerged. Because measurement changes behavior, and systems adapt to what's measured. Stock indices didn't distort markets intentionally, they simplified them. But simplification concentrates attention, and attention shapes behavior. Once a system measures itself continuously, those measurements become part of the system. That's not a flaw, it's a property. The stock market didn't always have a mirror, it didn't always have a scoreboard. But once it did, it couldn't look away. Not because people stopped thinking, but because they started watching the same signal. And when everyone watches the same number, that number starts to matter far more than anyone intended. The index didn't just describe reality, it became part of it. That's the quiet lesson. Markets don't only respond to fundamentals, they respond to what they can see. And once a system starts watching itself, it never behaves the same way again.